So thank you both very much, for your very kind introduction, and also, of course, for the invitation to speak tonight. It's a great honor and privilege for me to be here, to give you this short, what I hope will be a short and hopefully even interesting talk, but mostly actually to stimulate some conversation. So I hope that at the end of this, we'll have some time to have a Q&A session to stimulate some debate. Because the good news about this particular topic is that there are no right answers at the moment. We're still in the early stages. But I just wanted to share some ideas and some thinking about what's happening to our industry and potentially where it might be going. It was a very easy decision to accept this invitation, because what many of you in the room don't know is that when I found out that this was going to be in New Delhi and in this particular location, I realized that in fact I used to live and in fact was born about 1.5 miles away from here. I was born actually in Old Delhi in Dr. Sen's nursing home, and my parents lived here about 1.5 miles away for my first 3 years of my life, and then moved to Hyderabad for the next 4 or 5 years of my life. And in fact, my parents then retired back to India after having been back in the UK, and my father passed away and is buried in Kannur, and my mother still lives there. So India is very much part of me, and although I am not still technically part of India, it's always a great privilege and pleasure to come here. So that's the real reason I'm here, is to have a bit of a pilgrimage and to visit my home country. I also felt that, having read a little bit about, and please forgive me, although I was born in India, my pronunciation of Indian names is not so great. So I'm going to use the abbreviation Sir PT, if that's all right with everybody. But when I was reading about him, I felt that he would be certain, if he was here today, if he was with us today, he would be certain to be at the forefront of this particular debate at this particular time in our history. He strikes me as that sort of person. And he would have also, I think, enjoyed the subject of today, the new paradigms in banking, although I do wonder whether he would have used the word paradigm, in that I think it's become a bit of a buzzword put around by consultants like me. So I'm sorry, I take the blame for that, or some of the blame anyway. Many of my colleagues from other firms are using it all the time. It did actually remind me a little bit of the story of the shepherd who is out in his fields minding his sheep one day, minding his own business, when suddenly this Porsche 911 pulls up next to the field, and this very sharp-suited young man gets out of the car and beckons to the shepherd and says, "Come over, come over." So the shepherd wanders over, and the young man says, "Look, if I can tell you how many sheep you have in your field, in your flock, can I have one?" And the shepherd says, "Yeah, okay, fine." So this young man gets his PC out of his car, dials up to the satellite, which takes a photograph and immediately gives him a readout of how many sheep there are in his flock. So he turns to the shepherd and says, 263. And the shepherd says, "Okay, fine, yeah, carry on." So the guy picks up an animal, squeezes in the back of the Porsche 911, and is just about to go when the shepherd says, "Excuse me, if I can tell you what you do for a living, can I have it back, please?" And the guy says, "Yeah, sure, no problem." Shepherd, he's not going to know. So the shepherd goes, "You're a management consultant." And he says, "For McKinsey." And he said, "How did you know that? How did you know that?" And he said, "Well, you came here uninvited, you told me something I already knew, and you clearly know nothing about my business because that's my sheepdog in the back of your car." I'm not sure what Sir PT's view of management consultants would have been. But as I said, I do believe he would have been deeply involved in this particular conversation, because clearly banking and financial services was something that was close to his heart. So, I guess before we start, I should answer one question that I have been asked, not here, but I have been asked and probably would have been asked anyway at the end of this speech, which is, look, haven't we been here before? We all remember, well, I think, yes, everybody in this room remembers 2002 and the dot-com bubble, and, you know, people were going to be billionaires and suddenly they didn't own anything. Is this not the same thing, all this fintech stuff, all of this digital disruption that's going on? And my answer would be no. And the reason why my answer would be no is I think that there were some conditions precedent in 2002 which simply don't exist today. In 2002, what was actually happening was that people in the dot-com world were simultaneously trying to create new business models, new infrastructure, and completely change and drive new consumer behavior, all at the same time. Whereas today, what we have is a situation where we have vastly increased computing power, We have vastly improved user access. We were talking about mobile banking or mobile payments in the last session. Some studies show that, or say that by 2020, there will be 6 billion smartphones, not mobile phones, smartphones in the world. 6 billion. That's nearly one for every person in the world. Now, we know that's not true today, that's not true in India, that's not true in Africa. But if we see this incredible advance of the smartphone, that means that user access is pretty much ubiquitous. And finally, what we're seeing is exponential adoption speed for new technologies or new things. If you think about how long it took for radio, for television, even for the mobile phone to be adopted, and now you think about how long it took Amazon to get 1 billion customers, how long it took Facebook to have 1 billion users on Facebook, how long it now takes for an app to reach 1 million people in the world. It's now down to days or even hours in some cases, and that speed of adoption is something that we've never seen before. So what these organizations that are now in the market trying to disrupt financial services are doing is really two things. They are still trying to create new business models, and I guess what they're trying to do is change or improve the customer experience. But they're not trying to introduce customers to something that has never been done before, because elements of these things have been. But they are trying to do these new business models, but on the with the background of this incredible change in technology that is driving this growth. So I am convinced that the time is now. This is happening. It's happening today, and will continue to happen in the years to come. And we can't stick our heads in the sand and ignore it as bankers or as responsible leaders. So I'll pretty clearly, therefore, state my position on this is that this is happening, this is now, and we absolutely need to take cognizance of it. To that end, then, what I wanted to do for the next 20 minutes or so is share some output from a report that I was part of doing for the World Economic Forum, where at the beginning of 2014, we were really asked to look at how disruptive innovations are shaping the way that financial services are structured, provisioned, and consumed. So that really was the exam question. And we basically boiled this down to 3 key questions, which is, which of these innovations are actually the most impactful and relevant to financial services? Because not all are, and not all will be impactful and relevant. The second question was, how will those innovations then impact the way in which financial services are delivered, or are consumed, or are structured? So what is the impact of all of this going to be? And what would the implications of this change be on customers, on institutions themselves, and on overall financial services marketplace? So to answer that, what we've done over the last 18 months or so is worked with a huge range of stakeholders in financial services, industry leaders, innovators, and we've held a number of working sessions with participants from around the world. Just like to share one observation, and it actually, I was reminded of this during the last session, when one of the participants, I apologize, I can't remember who, was talking about Wells Fargo. And I know John Stumpf reasonably well, the CEO of Wells Fargo. I invited John to speak at a conference that we held in 2012 in Istanbul. And I asked him to speak on the subject of mobile banking and the impact that that was going to have on general retail banking. And I know that John won't mind me sharing this story, because what John said at the time was that he didn't really believe that it was going to have much of an impact. He thought that people still wanted to go into branches, or as he called them, stores, and that, you know, this isn't going to change very much in the next 10, 15, 20 years. 3 years later, I invited John back to speak on the subject of mobile banking. And he said to the audience at that time, he said, "I have completely changed my mind. I'm allowed to do that because I'm the CEO of the largest bank in the Western world, so I can do really what I like. So I have changed my mind. And I now believe that this is a radical departure. I've just closed 500 branches of Wells Fargo in the US, and I am completely revolutionizing what those other 2,000 branches are going to be doing in the future." And that was John Stumpf changing in 2 years. What was interesting in this project was in the first workshop that we held in Davos, surrounded by very senior individuals from all of these sort of major institutions that you can see up here, and some innovators in the room. There was a healthy degree of skepticism from the industry participants as to whether this was really going to make an impact or not. The second workshop, which was 1 year later in Davos, the mood had completely changed. And I think that is the scary and exciting thing about all of this, is that this is moving at pace. There isn't time to sit around and wonder whether it's going to happen or not, because it's happening. One of the first things that we tried to do in the program was to get some way of defining what disruptive innovation really means in financial services. So we decided what we would do is we'd look at this in terms of the sort of 6 key areas within financial services, such as payments, insurance, deposits and lending, capital raising, investment management, and market provisioning. And then we tried to map the innovations to those 6 segments, if you like, of the financial services orange. And then what we did was identified 11 clusters where we put these innovations or these new developments together, to really based on how we felt that they impacted the core functions of financial services. So we came up with some of these clusters like payment rails, cashless world in the payment space, crowdfunding in terms of capital raising, alternative lending mechanisms in terms of deposits, etc., etc. And we felt that these were an interesting and new way of looking at how disruption is happening in our industry. But what we then did is we said, let's consider a number of scenarios, and let's see what the degree and nature of that change will be, dependent on how far or how near, if you like, we go in each of those clusters. And then we looked at the implications of those scenarios on customers, on incumbent institutions, and on the overall financial services ecosystem. So what I wanted to share with you is just a few of the insights that we gained from that. By the way, the full report is freely available on the World Economic Forum site, and we can certainly get all participants a link through to that site should you want that. And it's a big report. It was probably not a Delhi to Mumbai flight. It might have to be an international flight to read all of it. So let me talk about some of the insights that we gained. I'm going to cover 6 of these 10 relatively quickly, and then like to focus on 1 or 2 of the remainders in a little bit more depth. But I think the first insight, actually, in a way, is one of the most obvious, and yet one of the most important from my perspective. And that is that we, coming into this, and looking at this sort of hectic ecosystem that was developing out there, we thought, this is random. No, this is just a bunch of geeks in garages pulling together stuff in a really uncontrolled and random way. And actually what we found is that is entirely not true. Innovation in our industry is happening in a very deliberate and very predictable way. And the way in which you can predict that in your organizations or in your ecosystem is to look at where there are the greatest sources of customer friction and where that meets the largest profit pools. And let me just take one example, which we talked about for an hour and a half just half an hour ago: payments. Why has there been so much innovation in payments? Because payments, as a process, historically, caused enormous customer friction. It was expensive, it was difficult, it wasn't very timely, and actually it also created, for the banks, pretty massive profit pools. And in some estimations that I've seen, people will estimate that 33% of the profit of most financial institutions is actually linked to the payments mechanism within those institutions, which, by the way, means that if there's a threat, that's a large threat to the profitability of most banks around the world. So that's, I think, a really important insight, because what that means for me when I talk to my clients, and what that means for you when you think about your organizations, forget about this disruption stuff. When you're just thinking about, how do I improve my business tomorrow? Look for the points where there's greatest customer friction and where that intersects with large profit pools, because that's where you're going to be attacked. That's what Lending Club are doing. That's what the Personal Capital or Wealth Builder are doing in the automated management, wealth management sector. That's what Bison are doing on the platform side. So that would be my first insight, and I guess my first recommendation. Secondly, we found that innovations are having the greatest impact when they employ business models that are platform-based, that are modular, that are data-intensive, but capital light. These innovations are not things that require billions of dollars of capital to fund. They are capital light, they are fail fast, fail quick, or don't fail fast and deploy quickly and easily. The third one would be that we felt that although everyone talks about the impact on the banking sector, we actually believe that in the long run, potentially the greatest impact may be felt in the insurance sector. And why do we feel that? A couple of reasons. Firstly, the disaggregation of the insurance value chain through new players, new entrants coming into that value chain and taking out some of the value inherent in that. And then this whole concept of connected insurance. I think also one area which we're now beginning to explore in greater detail is how will innovations such as the blockchain affect the way in which you gather and use information for insurance underwriting. And I think there's a really interesting question, which I ask some of my colleagues who are actuaries, which is, what actually is the future of the actuarial profession when machines will come up with much more tailored predictions that are tailored to individuals rather than to generic groups of, middle-aged gentlemen? What's the future of that profession? And therefore, what is the future for insurance companies? So I think there's a really interesting impact on insurance. What we believe is that incumbent institutions will employ parallel strategies which will be both in terms of aggressively competing with new entrants, but also both leveraging their own assets to give those entrants some infrastructure and access to the market, but also will subsume some of those new entrants into themselves. And I think the latter is already happening. I know it's already happening. If you look at what's going on in places like Level 39 in London, where essentially what the UK government have done is brought a whole bunch of fintech entrepreneurs together, put them in Canary Wharf, basically put them in a transparent box so that all the banks that are stationed all around them can go look at them and pick out the best ones that they want. I mean, it's a very clever move, but it's really about incumbent protection in many ways. But it's keeping them close to financial services. But these parallel strategies will have to happen. So you will have to compete with them, but you'll also be able to use them and indeed become a supplier to them if you believe that that's going to help. And you see that now with Wells Fargo, for example, sitting behind Lending Club in the US, and a number of other examples around the market. The fifth point really was that we think that this level of collaboration will need to extend beyond the entrepreneurs and the incumbents, but to include people like regulators, to include governments, and indeed to really include everybody within the ecosystem, to enable us to manage the risk profile of the industry. And we're talking now a lot with the World Economic Forum and ourselves with regulators around the world to make sure that we bring the regulators into this discussion. Where this works, or where this has worked, it works extremely well. And I'll just give one example which I think is particularly relevant, and that's WeBank. Who's heard of WeBank here? So WeBank is a new bank that's just been launched in China. It is actually the banking arm of Tencent. And Tencent, as you know, is a mobile phone operator. Tencent is also has an online shopping business, a very large one. We always hear about the Amazons of this world, but Tencent's online shopping business has something like 450 to 500 million customers. It also owns WeChat, which is the Chinese equivalent of Facebook and WhatsApp rolled into one. So doing what the Chinese do best, they took the best from other places, smashed them together and created something new. And you know, whether you call that innovation or not, I actually think that's incredibly innovative. So those three elements are all owned by Tencent. So what Tencent did is they said, well, we're going to apply for a banking license. And instead of let's go through the banking license application and do the business model and all that normal stuff, they went to the regulator and said, we want to do this. Would you mind working with us to do this? And the regulator said, yeah, that's fine. We'll do that. So the regulators actually became part of the project team, not necessarily on a day-to-day basis, but on a gated basis. So the approval process from the regulators was incredibly foreshortened, and actually the regulator was involved in the creation of this new bank, WeBank. And why that was so important was because Tencent were doing something radically new with this bank. And the radically new bit is not the fact that it's mobile and it's on the net and all the rest and the products and all the rest of it. Because frankly, it's the same as everybody else's mobile and on the net thing. But the radically new bit was Tencent realized that they had extraordinary degree of information about 850 million Chinese customers, from their mobile phone records, from their social media records, from their online shopping records. They knew so much more about their customers than, frankly, any current take-on process would give you in terms of real hard data and information about customers. So what they wanted to do was to use that information to pre-approve customers for current accounts, for loans, credit cards, etc. And when they launched, they had 147 million customers pre-approved for current accounts, credit cards, and revolving credit of other forms. And that was all approved by the regulator as well. My point of the story is, by involving the regulator in this innovation, actually, we can come up with really new and interesting things that will be, if you like, bulletproof, and from a regulatory point of view, will be managed and the risks will be significantly reduced and managed. Final point here, before I go into a little bit of a deep dive, is disruption is not a one-time event. There will be a continuous pressure to innovate, pressure from customers, pressure from regulators, pressure from the market in general. And this will affect both the business models and the long-term structure within the industry. And I always get concerned when I hear senior executives in banks going, 2016, year of innovation. And you go, right, okay. What about 2017? Oh no, we'll be on to something else by then. You can't stop innovating, because if you do, these guys who are innovating around you will kill you. There is no doubt about that. So I guess my point here is that innovation has to become part of the lifeblood of your organization. It has to be the way in which we do things around here. It's not a one-off event. I'm going to cover some of these points in a bit of detail, in a little bit of detail, not a huge amount of detail, in a moment. But in fact, why don't I do that straight away? Firstly, we believe that the universal banking model is under threat. It will start to become unbundled, and niche entrants will start to develop some credible point solutions, and customers will migrate to the best of breed in terms of elements of the value chain. And why is that important? Well, I think the danger here, unless we do something about it, the danger here is that the incumbent financial institutions, particularly the universal banks, will be left with the expensive, low-margin, dull stuff. And all the high-margin, cheaper, cooler stuff will migrate to other people. And if it does, you actually start to lose the customer franchise. And the customer franchise will then be dissipated amongst all of those new entrants. You know, one of the great things and one of the great assets that the financial institutions have today is the data that you have in all of your systems around the institution. The problem is that if that data disappears because it's now being in somebody else's little startup, and all you're getting is the end of the transaction, you will not be able to do all of that cool data mining stuff that you want to do to get closer to your customers, to find out more about what they want and need going forward. I think also it'll increase price competition in all of those products and segments. And the problem on price is most of your institutions are saddled with legacy. Legacy comes at a cost. Replacing legacy comes at an even higher cost, whereas these new guys don't have legacy. And in fact, I read only yesterday of a new bank that's launched in the UK, which has no back office, and get this, no front office. Exactly. No back office and no front office. Begs the question, what do they actually do? Well, we'll answer that some other time, but it's interesting. They have basically outsourced everything to other players. Obviously not everything, because they do treasury management, balance sheet management, all that stuff, but the functions sit outside their organization. So I guess some key questions come out of this, which is, if you are a universal bank, will you remain one? Or will you focus on specific products, specific markets, or specific segments where you believe you can build sustainable competitive advantage? How do you protect your customer relationships without providing those universal services if that's the way you decide to go? What are these products and markets and segments that you want to or will be in the future? And how do you maintain profitability when you're being pushed into low-margin products and services, and in particularly in areas where you're not choosing to participate? Second thought would be, there's a real challenge to the traditional term structuring and leverage role of financial institutions. And there's a real danger that this will or could become substituted by new sources of capital as innovative products erode banks' core deposit base. You know, for ever, in fact, for the whole time I've been working in financial services, the common belief, and it's still belief that's held today in many places, is that the fact that we are deposit takers insulates us from the worst effects of change. Because in pretty much every jurisdiction, you have to be a regulated entity to become a deposit taker. Yes, but you think about what Alibaba and Alipay are doing in China. If that's not deposit taking, I don't know what it is. And indeed, obviously what they then did was they built some cool products in the asset management space into which they could siphon implies that it was underhand, into which their customers could move their balances. Now that feels a lot like deposit taking and asset and wealth management to me, but they didn't need a license, they were not regulated, and they made a ton of money out of it. And more importantly, they siphoned deposits out of the banking system. So that's an example of a potential danger. So the future, or questions for the future are, will you and can you still continue to fund your investments through retail sources of capital, or will you have to rely more on wholesale funding and the capital markets? How will you evolve your core propositions to avoid that erosion or that potential erosion in the core deposit base of your institutions? And how will you protect the margins, particularly against those institutions or those organizations that will be specializing in financial engineering? One of the other great beliefs that has been held as a universal truth, as someone once said, is that scale matters. I'm big, and therefore it's really unlikely that I'm going to be attacked or taken out. Well, we're seeing, as I mentioned, you know, with the bank that has no back office and no front office, we're seeing new entrants into the market where scale doesn't matter. Size is not important in certain aspects of their businesses. So, you know, there are processes now that are going to be freely available as a service out there in the cloud, which will give organizations access to sophisticated capabilities that hitherto had only been possible within the large-scale monolithic systems that sit within financial institutions. And this is going to drive, I think, a growth and a blooming of new organizations that are going to come up and threaten to take away your customer bases. Also, I think traditional mechanisms of measuring customers' risk profile will lose their efficacy as new models and new data sources emerge. Someone in the last session also mentioned the potential use of social profiling, social media, etc., in the banking system. Well, this is happening today, and in fact, we were involved in a pilot in Peru, where two banks in Peru started to use a psychological or psychometric profiling system to look at the creditworthiness of potential customers. These customers, much like many customers in India, were people without any credit record. They were new to credit, new to the market, so there was nothing really to go by in terms of, you know, the credit agencies, etc., the rating systems and credit agencies. So they used psychometric profiling, which was designed by a professor in Harvard, which really said, look, from what we know about Chris Harvey's character and the sort of person he is, we believe that he is either likely, obviously in my case, or unlikely, in some other people's cases, to repay this particular loan. What we found in the tests and in the pilot was this particular approach was something like 40 or 50% more likely to predict non-performing loans than traditional credit scoring methods. And this is obviously now being increasingly sophisticated by use of social media to enhance the data that we have about our customers. So I think these scoring mechanisms will become less relevant. I think we need to start thinking about how we can use some of this new technology to drive much more individualized ratings, much more individualized assessments of our customers and of their propensity to buy, to sell, or to repay in the case of a loan. So I'll draw a line there because I think that's probably enough of my voice for now. But what I thought I would just end with is really to go back where I started, which is to say that I really do believe that this is happening. I don't think it's something we can or should try to avoid. My own view, actually, is that most financial institutions will not die and wither on the vine. I think most of you understand this and will start to take on the challenge, take up the challenge. You will have to break some eggs along the way, because you will be running up against some very entrenched views and behaviors within your organizations. And it is not just a technology issue, this is a massive change management issue to change the way in which your people think, the way in which your managers manage, and the way in which your organization works in the future. So it is a big challenge, but I actually believe that most financial institutions are up for that. And if the regulators come on side to work alongside with financial institutions to do this, and if governments can support that, then I think we have the basis of a good way forward. Just in final point is in terms of this report that I sort of highlighted some of the findings from. The next stage is, I think, going to be quite interesting, because we've been asked now to look at 3 further issues. The first one, and I've already mentioned it, which is what are the regulators going to do, and how can we better partner with regulators and financial institutions and entrepreneurs in that ecosystem to make this work in the future. The second thing that we're going to do is, again, I think really, really interesting, and we touched on it a little in the last presentation, or the last session, which is looking at digital identity. Is there a way in future that we can have a single repository of digital identity all around the world, 8 billion people or whatever it will be by then, so that we can really know our customer and not have to go through all of the rigmarole that we have to do today. Now, it's unlikely that it's unlikely that the answer is going to be yes, and let's do it by January, because I think that might be a bit difficult. But the answer, I think, might be that we will come up with some protocols around which we can have if you like, a common set of characteristics of what a digital identity might look like, and then we can take that forward. And the third piece, which I think is hugely interesting and potentially the subject of an entirely different conversation or entirely new conversation, is what's the blockchain going to do to financial services? And if I just digress slightly for 1 second on that, I was in Singapore on Friday and Saturday, and I'm doing some work for the Monetary Authority of Singapore at the moment, looking at what does fintech mean for Singapore as a financial hub, a financial center. And I opened the meeting, it was a meeting of about 30 people, I opened the meeting by asking the minister what he was going to do about the 150,000 people in Singapore who were about to lose their jobs. And he looked at me slightly awry and said, well, what do you mean? I said, well, Minister, I think on the last count there are about 280,000 people in Singapore who work in financial services. By my reckoning, about 200,000 of them work in middle and back offices. And if the blockchain does what I think it's going to do, there won't be any middle and back offices. So what are you going to do with the 250,000 people, the 150,000 people that used to work in the back office but aren't there anymore because they're not needed? And he said, we should probably think about that. I said, yeah, I think we should. So I think this blockchain discussion is going to be really interesting, and I'm excited to see and try and understand a little more about where that's going to take us.